The market priced in rate cuts. Then inflation printed 3.8% instead. That tiny number may quietly cost high earners thousands this year. And the Fed's next move is the part almost nobody's modeling correctly. Most investors assumed inflation was basically contained. Wrong. Headline inflation slowed last year, but the sticky categories, the ones tied to real household cash flow, never fully normalized. And now they're re-accelerating at exactly the wrong moment. This isn't based on social media macro takes. The framework here comes directly from recent Bureau of Labor Statistics CPI releases, Federal Reserve projections, and Treasury market repricing after the latest inflation data. Educational only, not investment advice. And one limitation up front: CPI is backward-looking. Markets care about where inflation is going next, not where it was last month. Here's the part that matters. Inflation doesn't have to explode higher to damage your purchasing power. It just has to stay persistently above trend. At 3.8%, a household spending $120,000 annually is effectively losing several $1,000s a year in real purchasing power compared to a stable 2% environment. Simple, quiet erosion. And the composition matters more than the headline. Shelter, insurance, services, energy spillovers, these categories move slowly, then compound. The Fed watches those carefully because they're harder to reverse without slowing demand. Now notice what happened immediately after the inflation print. Treasury yields repriced within hours. Mortgage expectations moved. Rate cut probabilities dropped. Equities rotated defensively. Not because 3.8% is catastrophic, but because it suggests inflation may be structurally sticky longer than markets hoped. Here's the soundbite worth remembering. Inflation hurts twice, at the register and in asset pricing. Your groceries cost more. Then your future borrowing costs reprice too. And this is where most commentary gets shallow. People focus only on the Fed funds rate, but financial conditions tighten before the Fed even acts. Bond markets front-run the move. The model assumes, look specifically at the post-2023 data. Markets repeatedly underestimated how resilient consumer spending remained despite higher rates. That resilience keeps inflation pressure alive. But ask yourself this: if inflation's still sticky, why are consumers still spending this aggressively? You might be thinking, if rates are this high, shouldn't inflation already be collapsing? Reasonable question. The answer is timing. Large parts of the economy refinance slowly. Corporate debt rolls over gradually. Shelter inflation lags reality by months. Wage growth adjusts unevenly. And there's another issue. A meaningful share of higher-income consumers still hold pandemic-era low-rate debt while earning elevated money market yields on cash. So spending hasn't slowed enough to fully cool service inflation. Now here's the second objection. Okay, but the Fed can just cut anyway. Technically, yes. Politically and financially, much harder. If inflation stabilizes near 3.5% to 4%, aggressive cuts risk reigniting inflation expectations. Federal Reserve officials have repeatedly signaled they'd rather hold restrictive policy longer than repeat the stop-and-start mistakes of the 1970s. That matters directly to portfolios. Long-duration assets become harder to justify. Refinancing windows narrow. Equity multiples face pressure from higher discount rates. Cash suddenly remains competitive longer than investors expected 6 months ago. Mid-video question: cash or equities right now? Drop one below. But here's the catch. Official inflation data may still understate what many high-income households are already feeling in insurance, education, healthcare, and housing-related cash flow. Take 2 households. Sarah locked a 2.8% mortgage in 2021. Large cash reserve, mostly fixed expenses. Her portfolio earns respectable short-term yield today. Inflation annoys her, but she absorbs it. Marcus looks wealthier on paper. Bigger home, variable business expenses, higher insurance exposure. Refinancing needs within 18 months. Same inflation print. Completely different outcomes. Marcus gets hit from multiple directions at once. Operating costs rise. Borrowing costs stay elevated. Future refinancing gets repriced against stubborn inflation expectations. Look, I'll be honest with you. Most people focus on whether inflation feels politically bad. Markets care whether inflation remains financially persistent. That distinction changes everything. And one more thing investors often miss. Headline CPI can cool, while services inflation stays elevated enough to keep policy restrictive. That divergence matters far more for asset pricing than a single monthly headline. Here's the framework. Layer 1. Extend your liquidity runway. High earners underestimate how valuable optionality becomes during prolonged restrictive policy. Layer 2. Stress test refinancing exposure now, not when markets panic. Layer 3. Separate real pricing power from speculative growth in your portfolio. Companies able to pass through costs behave differently in sticky inflation environments. Non-negotiable. And monitor 3 data points monthly: services CPI, wage growth, and the 10-year Treasury yield. Those together tell you more than headlines alone. The goal isn't predicting every Fed move. It's becoming the type of investor who understands how inflation quietly rewires cash flow, valuations, and borrowing conditions before consensus reacts. That's the edge. And the next blind spot most investors still miss is this. The Fed does not directly control your mortgage rate, business loan pricing, or most long-term borrowing costs. The bond market does.